Hello and welcome to this session in which we will discuss the objective of an audit. We will discuss the objective of an audit from the AICPA perspective as well as the PCAOB. Although both have the same objective, I always like to remind you that the AICPA auditing standards deal with private companies or non-issuers. However, PCAOB, when you audit public companies, or they are called issuers. Your CPA review course might call them issuers. That's fine. Also within this discussion, we have to explain or we have to lay out the responsibility of management for the audit as well as the responsibility of the auditors. Obviously, they are conducting the audit. We will start by discussing the objective of an audit as per AICPA. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So the purpose of an audit is to do what? Is to express an opinion. Give an opinion, an independent evaluation presented as an opinion. Our say as the auditor regarding what? The fair presentation of the company's financial statements. Are the financial statement fairly presented? What do we mean by fairly presented? It doesn't mean they are correct or they are good, in quote, good financial statements. Basically, we're looking to see if those financial statements are in line with the established accounting framework. Now, what is the established accounting framework? In the US, the established accounting framework is United States generally accepted accounting principles. If you are outside the US, you would use the International Financial Reporting Standard, or known as IFRS, or you can use some other standard, but you have to have a standard. Now, what is the purpose? Okay, so we know we issue an opinion about the fair presentation of the financial statement. For what purpose? Why? Well, the reason is simple. Is to boost the level of trust, the level of confidence that stakeholders is anyone that's going to rely on the financial statements. Usually we are referring to investors and creditors, but anyone is a stakeholder. Anyone that uses the financial statement, they need this opinion to make their judgment about the fairness of the financial statement. Now, this is the AICPA private companies. How about the PCAOB? The objective is basically the same, with a slight exception. For the PCAOB, we need to report on the internal control in addition to the financial statements. And we covered this in a separate recording when we dealt with the internal control. So this session is already basically covered, internal control reporting. Now let's move to the management's responsibilities. What is management responsible for? And that has to be clear for the management, for the auditor, as well as for the users. So the responsibility of the management is for establishing accounting policies. They choose which accounting to use. Also, they need to establish and maintain robust internal control. The internal control is the responsibility of management. And they are also responsible for the fair presentation, anything that's presented in the financial statement. All of this lies with the company's management, not auditors. Simply put, management is responsible for the financial statements. Management is responsible for establishing and maintaining a robust internal control. Well, I hope this makes sense, because given the day-to-day involvement in running the company, the management team, the people that work with the company, they possess more knowledge about the company's transactions, assets, liabilities, lawsuits, disclosures. Obviously, because they run the company on a day-to-day basis. The auditor, on the other hand, understand these matters, internal control and the financial statement, in a limited manner. It's only because they are collecting information during the audit. So they don't work with this on a day-to-day basis. Now, management responsibility is very important in a sense that everyone needs to be clear about this. It's part of the annual report, 10K. There's something called the report of management, and we're going to look at a sample here. Under the report of management, we have a section called management responsibility. And under this section, we will clearly state, this is a sample report, responsibility for the integrity and objectivity of the financial information rest with Adam Company, the sample company that we are using. And those financial statements are prepared according to GAAP, applying certain estimates and judgment as required. Also, Adam Company maintain an effective internal control. Again, I'm repeating the same thing, financial statements and internal control. An important element of the internal control is an ongoing internal audit program. Now, if you don't know what internal control is for now, that's fine. Just policies and procedures to make sure the company is being run properly. Also, they talk about the audit committee, and the audit committee is composed solely of independent and non-management directors, just to emphasize the idea that corporate governance and internal control. This is a sample management report, but it clearly states management responsibilities. Now, also, management will sign CEO, CFO, and they will date this. Now let's move to the auditor's responsibility. Again, we're going to look at the big picture as per AICPA and PCAOB. So what's the auditor's job? Now, obviously, this picture is misleading because most evidence is no longer paper-based, but the fact is the primary objective of auditing financial statements is to obtain reasonable assurance, not absolute assurance, that the statements are free of material. Now, what is material? It means significant, important, misstatement, important misstatement, whether they are due to error or fraud, enabling the auditor to form an opinion. Remember, the objective is to form an opinion on the fairness and in compliance of the statement with relevant financial reporting framework. What are those financial reporting framework? GAAP, IFRS, so on and so forth. And after we do that, after we obtain that reasonable assurance, we issue a report. We issue a report on the financial statements and communicate that report to users. And we're going to have 10 to 15 lessons about various types of report that we can issue. Now, notice here reasonable assurance is highlighted in yellow because we need to understand what reasonable assurance. Reasonable assurance in contrast to absolute assurance. So reasonable assurance is not 100%. Notice I crossed out the 100%. Auditing standards stipulate that reasonable assurance is the highest. That's the highest level we can give, the highest level of confidence. Bear in mind, it's not guaranteed that the financial statements will be free. The concept, as opposed to absolute assurance, underscore the importance that the auditor is not providing a warranty or, in quote, assurance that the financial statements are completely free. As a result, even if an audit is conducted in compliance with the standards, it might not still detect a material misstatement. Why? There are 3 reasons why reasonable, not absolute assurance is provided in an audit. The first reason is sampling, the use of sampling. During the audit, the auditor samples. They don't cover everything 100%. They don't cover all the transaction. They select sampling. So that's the first reason. Now, even if they select the proper sampling, they might misinterpret the results. So let's assume we selected the proper sampling. That's really a representative of the company's situation. Well, when we interpret the result, we could make a mistake. So we could make a mistake in sampling. We could make a mistake in interpreting the results. Despite our integrity and good faith, we could still make errors in judgment. So that's reason number 1, sampling. Reason number 2 is use of estimates. Accounting use a lot of estimates, and estimates are inherently uncertain and will be influenced by some future event. What are some examples of estimates? Warranty, bad debt expense, contingencies, as well as many other estimates that we make about the future. Consequently, auditor must rely on evidence that's persuasive, not conclusive. Persuasive means it's good enough, strong and compelling for us, for now, because we can't have conclusive. Conclusive means 100% for sure. That's the second reason. The third reason is fraud. What is fraud? Is when the company decided to hide the error or basically defraud investors. Now the company, the management is in collusion, and that's very hard. It will be harder, not very hard. It will be harder for the auditor to discover the fraud unless they are engaged specifically to discover the fraud. When you conduct an audit, you are looking to make sure that the statements are free of material misstatement. But you are not looking, the assumption is there are internal controls, the statements are being prepared in good faith. If fraud is involved, then it becomes difficult. Because of those 3 reasons, we cannot provide absolute assurance. The auditor can only provide reasonable assurance. So it's very important to understand Why reasonable assurance? Let's take a look at this multiple choice questions from Farhat lectures. Which of the following best describes, I know this is the student's best questions when it says best describe, the main purpose of accumulating evidence by auditors during an audit about the financial statement. So why do we collect evidence? Well, let's see. A, to ensure the correctness of the financial statement. Well, we cannot ensure the correctness. We can't do that. We only can provide reasonable assurance that they are free of material error. We cannot ensure any correctness. So that's out. That's like basically providing positive assurance. We can't do that. Fulfilling the requirement of the Financial Accounting Standard Board. The Financial Accounting Standard Board has nothing to do with audit, so this is an easy elimination. C, defending themselves in potential lawsuits by client and third parties. Yes, when you collect evidence, you have to keep that in mind, collecting enough evidence. But that's not the purpose why you collect evidence. You're not collecting evidence thinking, well, I'm going to be sued. How do I defend myself? Well, you should keep that in mind, that if I'm sued, am I collecting enough evidence? Am I doing my job? But that's not the main reason. So by process of elimination, D must be the right answer, but we still have to make sure D is the right answer. Reaching a conclusion regarding the fair presentation of the financial statement in all material respect, absolutely correct. This is why we collect evidence during the financial statements, is to make sure the financial statements are fairly presented in all material respect according to some framework, which could be GAAP, IFRS, or whatever financial framework you are using. What should you do now? Go to Farhat lectures, look at additional MCQs like this one, true, false. That's going to help you do what? Understand this important concept, the objective of an audit as per AICPA, per PCAOB. What's management responsibilities in an audit? What is the auditor's responsibilities? Invest in yourself, whether you are a CPA exam candidate or an accounting student. Stay safe.